You're watching Top of Mind. We speak with experienced traders, analysts, and market thinkers to dig beneath the headlines and understand what's really driving metals and mining markets. Gold and silver have swung sharply in recent weeks, hitting fresh highs before pulling back as investors balance central bank buying, geopolitical tension, and persistent questions about physical supply. Well, joining me now is Vince Lanci. He's a veteran commodities trader known for his close focus on market structure and the mechanics of precious metals. Vince, it's a pleasure. Thanks for talking to us.
Thanks for having me here. I've been looking forward to this. The timing is good.
Well, look, so much has happened over the past few weeks. Gold and silver have been swinging hard lately. In your view, is this macro-driven or is the future market itself driving the turbulence?
That's, we talk about gold and silver, and I'm actually going to give you two answers. For gold, it's macro-driven, and it's driven by events and headlines and a little bit of hot money that's getting in the market ahead of other people. On the silver side, it is driven by mechanics. So the answer is all the above. So would you like me to be more specific on that?
Yeah, let's just talk about the distinction between these two things, because they're quite peculiar in their own regard, isn't it?
Yeah. Well, I mean, when you're looking at a market, look, I do a lot of granular work, but I also do a lot of big picture work. So I like to look for the synthesis between them. And the big picture for me has been the market is in a secular change. And that secular change is the remonetization of gold, the re-recognition of silver as a collateral asset, as a semi-monetizable collateral asset and a critical mineral. And what I look for things that happen within the mechanics of the market that show me that the structure is changing to adopt. I look for the evolution of the market. And when you talk about, is it the futures macro behavior, or is it let's say, the mechanics of it? And so I'm going to differentiate between those two for you because that's why it's such a good question. On the macroeconomics part of it, when you talk to someone about macroeconomics, all you're really talking about is how does the market act to domestic policy decisions? And unfortunately, or fortunately, depending on how you look at it, a lot of that is geopolitical now. So every time Trump says something, every time President Trump says something, it has implications for tariffs. Every time a military leader or something happens in the Middle East, it has implications for gold as well. So that would be macroeconomic drivers. So the macroeconomic drivers are we going to tariff? Are we not going to tariff? So, I mean, the most recent example that your viewers would know is President Trump. The Supreme Court the Supreme Court struck down President Trump's ruling for tariffs. Now, there's still a lot of gray area that they have to go through there, but upon doing that, that was a washout for metals. And then he responded that day with he's going to have a different type of a tariff that's going to be beyond that. And so that made the markets bounce. So look, if Trump is your president, you live in a pinball machine when it comes to gold, and more now than ever. Silver, just to be very brief, silver is mechanical. And by mechanical, I mean, over in China, you have a problem. You have a fund over in China, and that fund is a listed open-ended fund, which simply means it's like a mutual fund on an exchange. And the problem with that fund is it doesn't match up with real exposure. So you and I could buy as much of it as we want. They only have to buy one future. And so the net asset value got way above. And that's why we had a liquidation of silver that drove it down almost 50% because too many people were buying an asset that really couldn't accommodate. It was like 2 tons of groceries in a 1-ton bag, so to speak. And so the market had to digest that. So it's a little bit of mechanics and a little bit of macro.
Well, let's dig into that a little bit. I'd like to ask you, do quick futures-driven swings actually change the real picture for gold and silver, or are they just short-term noise?
Well, if you had asked me that question before, say, 2022, I would say they changed the real picture. Because you had a market with damaged psychology. You had a market that no one cared about. Even when it was rallying, it was never believed to be rallying. for any meaningful relationship, because people only looked at gold and silver, mostly gold, but silver as well, as a proxy for the dollar. Is the dollar strong? Well, then gold should be down. Is the dollar weak? Well, then gold should be up, because you're pricing gold in dollars. And so when the big sell-off in gold would happen, you would say, oh, can you be bullish after that? Does that change the fundamentals? There were no fundamentals. That's the problem. Gold was a pet rock that was seen as a proxy for the dollar. If you were bullish on gold, you would just sell the dollar. And that's because we were in a very neo-Keynesian economic environment. And during that neo-Keynesian environment, global reserve currency, dollar is king, everything's priced in dollars. And what's gold? Gold's not really used for anything. Nobody really wanted it. It was just, again, a proxy. But after the Ukraine invasion and the European as well as the US taking the sanctions and freezing assets for Russia, you change the whole structure of it. And so this is what I look for. And so this structure changed, and it said, wait a minute, we no longer want to own treasuries because that can be confiscated. And if that can be confiscated, we need to have another store of value. And what's out there? And gold is agnostic. It has no counterparty risk if it's in your possession. And all of a sudden, gold became an asset class again, as opposed to, just the tail on the dollar dog. And since then, now I'm going to answer your question. Since then, those little sell-offs, not little sell-offs, those big sell-offs, they don't matter anymore. They're opportunities. I mean, that's my opinion, trading my own book. Those are opportunities. Unless there's a news headline that's associated with peace on earth again and kumbaya with Russia and China, every dip in gold will be bought.
I tell you what could also be headlines when a big bank does these forecasts, right? If big banks, let's say Goldman Sachs, for example, are raising their gold forecasts, why do we still see these heavy futures sell-offs?
Well, okay, if this is to hold hands with people that are a little bit mystified by it, I'll explain it to you. A little bit of conspiracy for you, but this is how it works. The banks and the institutional investors get an idea. And that idea is, I'm bullish on gold for whatever reason. Maybe Liberation Day is going to be coming, and Trump is going to have his Liberation Day with the tariffs, so we'll buy gold in anticipation of that. And then the event happens, and then you have a washout. Well, that's the classic buy the rumor, sell the news. It's kind of like a bunch of people get into a position, and they look at it as the ramp up to, on the equity side, when you see stocks split, the announcement of the split is when the stock starts to go up. And then after it splits, the stock usually goes down. It's a buy the rumor, sell the news. It's not really that complicated, but that's basically it. And, the market, look, you have these central banks that are just constantly buying now, and they're underpinning it. And so you have a little bit of froth that'll get in it, and it gets quickly knocked out. But you do have a little bit of froth that gets in the market. So I would say it's again, opportunities for purchasers.
Vince, silver keeps leading the volatility. Up fast, down fast. Is that just silver's personality, or does the structure of silver market, and I think you touched on this earlier, make it more fragile?
Yeah, silver, well, I can tell you silver is gold on steroids in this respect. Now, the difference between gold and silver that matters the most is that all the gold on earth that's ever been mined is spoken for. It's there. It's here. We can find it. If you want gold or I want gold, we can always borrow it from someone else because it's not used in industry. It's not consumed. Silver, on the other hand, has a lot of industrial applications now. And those industrial applications make it quite more like a just-in-time metal. We need it today. We need it tomorrow. We can't wait 30 days for it. And so because of that situation, what you see is, you'll see, especially with the demand coming out of China for solar panel use, what you're seeing more and more is, we had a supply deficit for the last 5 years, and that's been getting met by above ground stocks. There are no more above ground stocks available. In gold, there are above ground stocks. You just go to a central bank and say, can I borrow you? You call them up and say, can I borrow your gold for 30 days? They go, sure. There is no central bank hoard of of silver to offset that. And so that's why you get your upside volatility, right? That's half of the story. The other half of the story is because silver is the poor man's gold, because silver has a historical attraction and a lot of religious fervor around it. I'm an acolyte, you're going to have it get overbought, and then what goes up must come down.
Okay, I find some recent moves of yours very interesting. I want to dive into that. You've recently suggested you're adding minor exposure via ETFs, including SILJ as an entry point. Vince, what changed for you? Why focus more on minors now?
Well, several things have converged, and I could probably tell all the several things by just telling you one little anecdote. One of the reasons miners have been so hated for so long is because the banks have something else to talk about. The analysts, whether it be Mag 7 or AI or what have you. Now, over the last 6 months, the AI stocks have started to falter because they're being pressured under the capex weight of money they're spending that they shouldn't be spending. Now, what I've noticed is a couple things have happened. First one was I saw a chart breakout. I'm not a technician, but I will use it for tactical purposes to make a decision. I've been friendly to miners, and I've been trading in and out, but never really committed. And I saw a chart breakout, and I said, okay, maybe I should pay more attention. And then I got two reports, one after the other. Now, first one was by JP Morgan, a very, very serious report. And the second one was UBS. Now, generally speaking, you always have to take a bank's report with a grain of salt. They look at equities like product, like anyone else does. But this JP Morgan report that I looked at was fascinating in that one of the reasons, circling back, that the miners don't do well is because the banks refuse to take their foot off their throat. So gold's trading at $3,000. What's the cost of an ounce of gold to pull in? All-in sustaining cost is, let's say, $2,200. They running it at $1,600. So they're valuing the miners with gold at $1,600 an ounce. Now gold goes to $5,000, and they all raise it to $2,600. So you have the banks telling their clients, do not buy miners because gold's not going to be here very long. Now here's where all that changed. 2 weeks ago, I started to see behavior at the tactical level that made me think people were changing their mind. And so, there's smoke. And the fire came when the JP Morgan report came out. And the JP Morgan report did something I've never seen a bank do before, talking about miners. And they said, we're going to raise our floor for gold from like 3,500 to 4,500, which was a very big jump and above their peers as well. And the reason it's significant is because they shared their calculation. And their calculation used to be, this is how much it costs to pull it out of the ground. This is what the cost is, and that's what our price is. That's their break-even price. But they added 3 new prices above the current market. And the current market prices they added were, I'll just tell you that the most important one, the most interesting one is they said, as part of our weighted value of I have a chart for it if you want to show your people later on. If you want to look at the weighted value calculation for what we think the price of gold is, we're going to now add in the potential for every dollar in the US being backed by gold. And that price for them is $9,300. So when you take that $2,500 price and you add $9,300 to it and you divide by 2, you divide by, there's 5 factors they're using now. You end up with a price of $4,500. So what I think has happened is, I think all of Wall Street, for cynical as well as honest reasons, is saying we need to start recommending miners. And in order to do that, we need to start re-rating gold as higher. So if gold is higher, they're going to tell their clients who are not stackers, they're not diehard mining people, and they're going to say, listen, gold we think is going to stabilize above 4,500. It's going to stabilize from 5,500. It might even go to 9,000. it's time to buy miners.
Yeah, what you're telling me brings Rick Rule to mind, right? Rick Rule has talked about selling a large portion of physical silver and redeploying into silver mining stocks for leverage. Do you agree with that logic? I mean, obviously, looking at what you just told me now, and what are the risks people are missing?
Yeah, that I agree with that logic. In fact, that was one of my factors in my own calculus. I'm going, Rick Rule's selling a lot of his physical. What did he do with the money? And he said, I'm buying miners, as you correctly pointed out. And I said, right, he's moving. Look, when a market has staying power, the commodity moves and then the industry grows. You know, you had Tavi on the other day, and he was talking about the industry is woefully small in terms of CapEx. And that's right. Money is coming to this industry now. And that money will go into certain things. You got tethers buying gold. You've got miners that are going to have vertical consolidation. And I'm not saying to buy miners because of a leveraged buyout or a takeover. I'm saying the industry is woefully underdeveloped, and the U.S. government needs it to develop. We need to make manufacturing great again if we're going to do anything to help the United States, as well as North America in general. So the end result is the industry itself is no longer the orphaned child. It's now front and center with rare earths at the point of the spear there. But precious metals are benefiting.
Vince, when you look at miners today, are you primarily hunting for torque to the metal price, or are you looking for company-specific mispricing? I mean, costs, balance sheet, jurisdiction, grade. What is it?
I look for operating leverage, not a financial leverage. So financial leverage, for anyone who's not familiar, means are they borrowing a lot of money, and do they get 10 to 1 for their money, and are they getting bang for the buck, and are they not hedged? Operating leverage is I want to see a company, doesn't have to be Newmont, but like a Newmont, that's well run, that has free cash flow, and has management that will do something smart with it. So those are the two types of leverage that I look at, operating and financial leverage. But to answer your question directly and very specifically, the type of miners I'm looking at now are miners that have proven management, which is obvious. They have positive cash flow, but are constrained for investment. They need money to develop what they have. So those are the miners. I want a miner. How can I put this? I want a miner that has a brownfield that he doesn't have enough money to explore, and who has other potential growth. And if somebody would just give him the money, he'd be able to do it. And I look at these companies as that's the type of company that Newmont's going to buy, or that's the type of company that the U.S. is going to invest in. So I look at companies that have positive cash flow but are constrained for capital and need investment. Good management with poor operating earnings. That's what I look for.
And just quickly, if I can indulge you on one last point, I mean, I often hear the sentiment, short-term volatility, but you've got a sort of a bull run in the long term. Do you share that sentiment, especially with these two metals?
It's almost the axiom is almost trite, you know. Another version of that we heard coming out of Wall Street was gold is overbought, but it's underowned, which is the same way of saying short term I'm bearish, long term I'm bullish, and that's fine. I'm different than most people when it comes to volatility. I like volatility. My background, my first career was as a market maker trading options. I'm an options trader, genetically. And as a result of that, I embrace volatility, and I like to trade around it. So if I think the market's too high, I'll sell it. If I think the market's too low, I'll buy it. And I think the market's too volatile, I'll just sit back and watch it or sell the volatility. But to answer your question directly, I think the volatility is really just beginning. I mean, silver's having a $5 range today, or gold's having a $100 range every day. And I think what we're looking at is an industry that had been suppressed for a long period of time and is trying to catch up in fits and starts. So I welcome the volatility. I'm not the normal person. I welcome the volatility. I don't have a problem with it.
Vince Lanci, it's been a pleasure. Before I let you go, if I can ask you so, if people out there want to follow you, where do they go?
Sure. The GoldFix is the newsletter that we publish, and it's VBL, Victor Boy Larry GoldFix on Substack. We're in the top 40 of financial newsletters on Substack. And you can also find me on X under VBL's Ghost.
Veteran commodities trader, Vince Lanci, thanks very much. It's been a pleasure.
Thanks for having me.